Money. We use it every single day, right? It's so baked into our lives, we don't even give it a second thought. But have you ever really stopped and asked why? Why does this whole system of paper and coins and numbers on a screen actually work? Well, let's dig in and unpack the incredible story of money and credit.
To get it, let's imagine a world with no money. Let's say you're a shoemaker. You've just made a fantastic pair of shoes, but you're hungry. You need wheat to make bread. So you find a farmer and you make him an offer. I'll give you these shoes for some of your wheat. Seems pretty straightforward, yeah?
Ah, but what if the farmer turns to you and says, "Sorry, I don't need shoes. I've got plenty. What I really need is a new shirt." Well, now you're stuck. Your simple trade just got really complicated. You have to find someone who not only has wheat, but also just so happens to need a new pair of shoes. This, this is a huge problem. And this problem actually has a name. It's called the double coincidence of wants. It's a fancy way of saying that for a trade to happen, you and the other person have to want exactly what the other person has at the exact same time. You can imagine how inefficient and time-consuming that would be, right? So, to solve this massive headache, humanity came up with one of the most brilliant inventions ever. A kind of universal language for value that everyone could understand and, more importantly, accept. And that invention, of course, is money. The magic of money is that it acts as an intermediary. Our shoemaker no longer needs to find that one specific farmer who wants shoes. Nope. He can just sell his shoes to anyone for money. Then he can take that money and buy wheat from any farmer. It splits one difficult transaction into two super simple ones. Problem solved. Now, in our modern economy, money really comes in two main flavors. First, you've got currency. You know, the actual paper notes and metal coins in your wallet, issued and backed by the government. And second, you have demand deposits. That's the digital money sitting in your bank account that you can access anytime you want with a debit card or a check. And that brings us to the role of banks. Think of banks as the essential matchmakers of the financial world. They take all that extra money that people and businesses deposit, the surplus funds, and they lend it out to people who need it, the borrowers. They're the crucial link that connects savers with spenders and investors. And that very act of lending opens up the next chapter in our story, credit. Now, credit is an incredibly powerful force. It can be a launch pad for dreams and opportunities, creating immense growth. But it can also be a dangerous trap. So what exactly is credit? At its heart, it's just an agreement. It's a loan. A lender provides something of value, cash, goods, whatever, to a borrower right now, all based on a simple promise that the borrower will pay it back down the road. And to see how this plays out, just look at these two stories. They show the two completely different faces of credit. On one side, we have Salim, the shoemaker. He gets a huge order, takes out a loan to buy the materials he needs, finishes the job, makes a tidy profit, and pays back the loan with no problem. For him, credit was a ladder. It helped him grow his business. But then there's Swapna, a farmer. She takes out a loan to pay for seeds and fertilizer, but then disaster strikes. Pests destroy her crops. She can't pay back the loan. The debt just gets bigger and bigger until she's forced to sell her land. For her, credit was a pitfall. Swapna's story is a really painful example of something called a debt trap. It's a vicious cycle where a loan, instead of helping you get ahead, pushes you into a situation that's almost impossible to recover from. It's a spiral of debt that just gets worse. This brings up a really important question.
Why did credit work so well for Salim but fail so catastrophically for Swapna? A huge part of the answer has to do with where the credit comes from. You see, there's a massive divide in the world of lending. We can basically split all credit into two big categories. First, you have the formal sector. These are your banks and cooperatives. They're supervised by a central authority, like the Reserve Bank of India, which sets rules for interest rates and how they operate. Then you have the informal sector. This is everybody else, moneylenders, traders, even friends and family. This sector is a total Wild West. It's unsupervised with no rules, which often means sky-high interest rates and unfair collection practices.
And if we look at some data from rural India, you can see how this plays out. While banks make up about half of the credit, look at that other big slice of the pie. Moneylenders alone account for nearly a quarter of all loans. That's a huge number of people relying on unregulated lenders. But this chart, this is where the inequality really hits you. In cities, for poor households, more than half of their loans come from these expensive, risky, informal sources. Now, compare that to rich households, where it's only 17%. The takeaway is clear. The people with the least money are forced to rely on the most expensive and dangerous forms of credit. So this is the challenge. How do we fix this? How do we bridge this massive credit gap? How can we make sure that safe, affordable credit is available to everyone so it can be that ladder to opportunity and not a trap? To figure that out, we have to ask a pretty basic question. Why can't poor families just go to a bank? What's actually stopping them from getting a formal loan? Oh, one of the biggest hurdles is something called collateral. Collateral is basically a security deposit for a loan. It's an asset you own, like land, a house, a car, that you promise to the bank. If you can't pay back the loan, the bank can take your collateral to get its money back. The problem is many poor households just don't have those kinds of assets to offer. But, and this is where it gets really inspiring, people have found an incredible workaround: self-help groups, or SHGs. The idea is so simple, yet so powerful. Here's how it works. First, a small group, usually 15 to 20 women from the same village, start meeting and saving money together regularly. Then, members can take out small loans directly from the group's pooled savings. And here's the brilliant part. After saving regularly for a while, the group as a whole becomes eligible for a loan from a real bank, using their collective savings as collateral. Finally, that bank loan is used to create real opportunities, helping members start small businesses. The impact of these groups is just massive. They completely solve the collateral problem. They empower women, helping them become financially independent. And it's not just about money. These groups also become a vital support network, a place where members can discuss everything from health to education, strengthening the entire community. This whole powerful idea is captured perfectly in this quote from Professor Muhammad Yunus, who won a Nobel Prize for this work. He said, "If credit can be made available to the poor people, these millions of small people with their millions of small pursuits can add up to create the biggest development wonder. It's about unlocking human potential on a massive scale." And that really leaves us with one final big question to think about. The stories of Salim and Swapna, the gap between formal and informal credit, the amazing innovation of self-help groups, it all points to one central challenge. How do we build a financial system that truly works for everyone? A system where credit is always a tool for opportunity and never, ever a trap.